Wealth Matters, a comprehensive guide to financial success. Introduction. Welcome to Wealth Matters, a comprehensive guide to achieving financial success and building lasting wealth. Whether you're starting from scratch or looking to enhance your financial portfolio, this book will provide you with the strategies, insights, and tools needed to reach your financial goals. Chapter 1. Mindset and Attitude. Achieving financial success isn't solely about crunching numbers or making smart investments. It starts with your mindset and attitude towards wealth. The foundation of financial success lies in your thoughts, beliefs, and attitudes about money. In this chapter, we will explore the importance of a wealth mindset, how to overcome limiting beliefs, and the significance of setting clear financial goals. The importance of a wealth mindset. Your mindset shapes your reality. A wealth mindset involves viewing money and financial success in a positive light and believing in your ability to achieve it. This mindset is crucial because it influences your actions and decisions. If you believe you can achieve financial success, you are more likely to take steps towards it. Key elements of a wealth mindset. Abundance mentality, believing there is plenty of wealth and opportunities available for everyone. Positivity, viewing financial challenges as opportunities for growth rather than obstacles. Growth mindset, believing that you can develop your financial skills and knowledge over time. A wealth mindset empowers you to pursue opportunities, take calculated risks, and stay motivated during setbacks. It helps you stay focused on your financial goals and continuously seek ways to improve your financial situation. Overcoming limiting beliefs. Limiting beliefs are negative thoughts and attitudes that hold you back from achieving your full potential. These beliefs can be deeply ingrained and often stem from childhood experiences, societal conditioning, or past financial failures. To achieve financial success, it is essential to identify and overcome these mental barriers. Common limiting beliefs and how to overcome them. Money is the root of all evil. Challenge. Understand that money itself is neutral. It's how you use it that matters. Money can be a tool for good, enabling you to provide for your family, contribute to causes you care about, and achieve personal fulfillment. Action. Replace this belief with, money is a tool that can be used for positive purposes. I don't deserve to be wealthy. Challenge. Reflect on why you feel undeserving of wealth. Often, this belief stems from low self-worth or guilt. Recognize your inherent value and that you deserve financial success just as much as anyone else. Action. Affirm your worth by saying, I deserve to be financially successful. I'm not good with money. Challenge. This belief often results from a lack of financial education or past mistakes. Understand that financial skills can be learned and improved with effort and dedication. Action. Commit to improving your financial literacy and remind yourself, I can learn to manage my money effectively. By identifying and challenging these limiting beliefs, you can replace them with empowering thoughts that support your journey towards financial success. Setting clear financial goals. Setting clear financial goals is a critical step in achieving wealth. Without specific goals, it's challenging to measure progress and stay motivated. Financial goals provide direction and purpose, helping you focus your efforts on what truly matters. The SMART framework. To set effective financial goals, use the SMART framework. SMART stands for specific, measurable, achievable, relevant, and time-bound. Specific. Clearly define what you want to achieve. A specific goal has a much greater chance of being accomplished than a general one. Answer the 5 W questions: who, what, where, when, and why. Example, I want to save $10,000 for a down payment on a house. Measurable. Establish concrete criteria for measuring progress toward the attainment of each goal. When you measure your progress, you stay on track, reach your target dates, and experience the exhilaration of achievement that spurs you on to continue the effort required to reach your goal. Example: I will save $500 each month to reach my $10,000 goal in 20 months. Achievable: ensure that your goal is attainable and realistic. While setting challenging goals can be motivating, it's important to set goals that are within your reach. Example: based on my current income and expenses, saving $500 a month is achievable. Relevant: your goals should matter to you and align with other relevant goals. We all need support and assistance in achieving our goals, but it's important to retain control over them. Example: saving for a down payment is relevant to my goal of buying a house within the next 2 years. Time-bound: set a time frame for achieving your goal. Without a deadline, there's no sense of urgency. Example: I will save $10,000 within 20 months by saving $500 each month. By setting SMART financial goals, you create a clear roadmap for your financial journey. These goals will keep you focused, motivated, and on track to achieving your desired level of wealth. Chapter 2: Financial Education. Financial education is the cornerstone of building and maintaining wealth. Understanding the basics of personal finance, harnessing the power of compound interest, and continually enhancing your financial knowledge through various resources are essential steps toward achieving financial success. This chapter delves into these key areas, providing you with the knowledge and tools needed to make informed financial decisions. Understanding personal finance. Personal finance encompasses a wide range of topics, but at its core, it involves managing your money effectively to achieve your financial goals. Here are the key concepts you need to understand. Budgeting. Budgeting is the process of creating a plan to spend your money. This plan helps you ensure that you have enough money for the things you need and that you're not overspending. Income. Start by calculating your total monthly income, including salary, bonuses, freelance work, and any other sources. Expenses. List all your monthly expenses, categorizing them into fixed, rent, utilities, and variable, groceries, entertainment, savings, and investments. Allocate a portion of your income towards savings and investments. Aim for at least 20% of your income. Tracking. Regularly track your spending to ensure you stay within your budget. A well-planned budget helps you control your spending, save for future goals, and avoid debt. Saving. Saving is setting aside a portion of your income for future use. It's crucial for financial stability and achieving both short-term and long-term goals. Emergency fund. Aim to save at least 3-6 months' worth of living expenses in an easily accessible account. This fund acts as a financial safety net for unexpected expenses. Short-term savings. Save for upcoming expenses, such as vacations, holidays, or big purchases, within the next 1 to 3 years. Long-term savings. Focus on goals like buying a house, funding education, or retirement. Utilize tax-advantaged accounts like 401(k), S, and IRAs for these purposes. Investing. Investing involves putting your money into assets with the expectation of generating a return over time. Investments can grow your wealth and help you achieve long-term financial goals. Stocks. Shares of ownership in a company. They can offer high returns but come with higher risk. Bonds. Loans to governments or corporations that pay interest over time. They are generally less risky than stocks. Mutual funds and ETFs. Pools of money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. Real estate. Property investment can provide rental income and potential appreciation in value. Understanding these concepts is fundamental to managing your finances effectively and building wealth. The power of compound interest. Compound interest is often referred to as the eighth wonder of the world because of its powerful ability to grow wealth over time. Unlike simple interest, which is calculated only on the principal amount. Compound interest is calculated on the principal and the accumulated interest. How compound interest works? Let's break down how compound interest can accelerate your wealth-building efforts. Interest on interest. With compound interest, you earn interest on your initial investment and on the interest that accumulates over time. This causes your investment to grow exponentially rather than linearly. Frequency of compounding. The more frequently interest is compounded, the greater the amount of interest earned. Common compounding intervals include annually, semi-annually, quarterly, monthly, and daily. Time horizon. The longer your money is invested, the more pronounced the effect of compound interest. Starting early gives you a significant advantage in building wealth. Example of compound interest. Imagine you invest $1,000 at an annual interest rate of 5% compounded annually. Here's how your investment would grow over time. After 1 year, $1,000, 1 plus 0.5 equals $1,050. After 2 years, $1,050, 1 plus 0.5 equals $1,102.50. After 5 years, $1,276.28. After 10 years, $1,628.89. After 20 years, $2,653.30. The longer you let your investment grow, the more substantial the gains from compound interest. This demonstrates the importance of starting to invest early and letting your money work for you over time. Financial literacy resources. Enhancing your financial knowledge is an ongoing process. There are numerous resources available to help you stay informed and make better financial decisions. Here are some of the best books, courses, and tools to consider. Books. Rich Dad, Poor Dad by Robert T. Kiyosaki, a classic book that explores the mindset differences between the wealthy and the middle class. The Intelligent Investor by Benjamin Graham, a comprehensive guide to value investing and building long-term wealth. Your Money or Your Life by Vicki Robin and Joe Dominguez, a transformative book on managing your money and achieving financial independence. Online courses. Coursera offers a variety of personal finance courses from top universities and institutions. Khan Academy provides free educational content on personal finance, including budgeting, saving, and investing. Udemy features numerous courses on specific financial topics, such as investing in stocks or real estate. Tools and apps. Mint, a budgeting app that helps you track your spending, set financial goals, and manage your money. Personal Capital, a comprehensive financial planning tool that tracks your investments, net worth, and retirement planning. Acorns, an investing app that rounds up your everyday purchases and invests the spare change. By leveraging these resources, you can continually enhance your financial literacy and make informed decisions that will help you build and maintain wealth. Chapter 3. Budgeting and Saving. Budgeting and saving are the cornerstones of financial stability and growth. By creating and maintaining a budget, you gain control over your finances and can allocate resources effectively to meet your goals. In this chapter, we'll explore the steps to create a budget, the 50/30/20 rule for managing your income, and various saving strategies to ensure you're prepared for both expected and unexpected expenses. Creating a budget. Creating a budget is a fundamental step in managing your finances. A budget allows you to track your income and expenses, helping you make informed decisions about spending and saving. Here's a step-by-step guide to creating and maintaining a budget. Step 1. Calculate your income. Start by determining your total monthly income. This includes your salary, bonuses, freelance work, and any other sources of income. If your income varies, use an average of the past few months to get a more accurate picture. Step 2. List your expenses. Next, list all your monthly expenses. Categorize them into fixed and variable expenses. Fixed expenses, these are regular, recurring expenses that remain relatively constant each month, such as rent/mortgage, utilities, insurance, and loan payments. Variable expenses, these are expenses that can fluctuate month to month, such as groceries, entertainment, dining out, and transportation. Step 3. Set savings and debt repayment goals. Allocate a portion of your income towards savings and debt repayment. Prioritize building an emergency fund and paying down high-interest debt. Consider your short-term and long-term financial goals, such as saving for a vacation, buying a home, or retirement. Step 4. Create your budget plan. Based on your income and expenses, create a budget plan that outlines how much you will allocate to each category. Ensure that your total expenses do not exceed your total income. Step 5. Track your spending. Regularly track your spending to ensure you're adhering to your budget. Use budgeting apps or spreadsheets to record your expenses and compare them against your budget plan. This will help you identify areas where you might be overspending and make necessary adjustments. Step 6. Adjust as needed. A budget is not set in stone. Review your budget regularly and adjust it as your financial situation changes. Life events such as a job change, a raise, or a major purchase may require you to update your budget to reflect your new circumstances. The 50/30/20 rule. The 50/30/20 rule is a simple and effective budgeting strategy that helps you manage your income by dividing it into 3 categories: needs, wants, and savings/debt repayment. How the 50/30/20 rule works. 50% for needs. Allocate 50% of your after-tax income to essential expenses that are necessary for living. These include rent/mortgage, utilities, groceries, transportation, insurance, and minimum loan payments. These are expenses you must pay to maintain your basic standard of living. 30% for wants. Allocate 30% of your income to discretionary expenses or wants. These are non-essential expenses that enhance your lifestyle, such as dining out, entertainment, hobbies, travel, and shopping. This category allows you to enjoy life while managing your finances responsibly. 20% for savings and debt repayment. Allocate the remaining 20% of your income to savings and debt repayment. This includes contributions to your emergency fund, retirement accounts, investments, and extra payments toward any outstanding debt. Benefits of the 50/30/20 rule. Simplicity. This rule provides a straightforward framework for budgeting that is easy to understand and implement. Flexibility. The rule can be adjusted to fit your personal financial situation and goals. Balance. It helps you balance essential expenses with discretionary spending while prioritizing savings and debt repayment. Saving strategies. Effective saving strategies are essential for financial security and achieving your goals. Here are some tips for saving, including building an emergency fund and planning for short-term goals. Build an emergency fund. An emergency fund is a crucial component of financial stability. It provides a financial cushion in case of unexpected expenses, such as medical bills, car repairs, or job loss. Aim to save at least 3-6 months' worth of living expenses in a separate, easily accessible account. Start small. Begin by setting a modest initial goal, such as saving $1,000. Once you reach that milestone, gradually increase your goal. Automate savings. Set up automatic transfers from your checking account to your emergency fund to ensure consistent contributions. Keep it separate. Store your emergency fund in a separate savings account to avoid the temptation to spend it on non-emergencies. Plan for short-term goals. Short-term goals are financial targets you aim to achieve within the next 1 to 3 years. These might include saving for a vacation, a new gadget, or a down payment on a car. Set clear goals, define your short-term goals, and estimate the amount you need to save for each. Create a savings plan. Determine how much you need to save each month to reach your goals within your desired time frame. Use high-yield savings accounts. Store your short-term savings in a high-yield savings account to earn more interest on your money. Adopt smart saving habits. Incorporating smart saving habits into your daily routine can significantly impact your financial well-being. Pay yourself first. Treat savings as a priority by setting aside a portion of your income for savings before spending on anything else. Cut unnecessary expenses. Identify and eliminate unnecessary expenses, such as unused subscriptions or frequent dining out, to free up more money for savings. Take advantage of discounts and rewards. Use coupons, discounts, and rewards programs to save money on purchases you already make. Chapter 4: Income Streams. In the journey to building wealth, relying solely on a single source of income can be risky. Diversifying your income streams not only provides financial stability, but also accelerates your wealth-building efforts. In this chapter, we will explore the importance of having multiple income streams, the differences between active and passive income, and strategies for creating additional income sources through side hustles and part-time jobs. Diversifying income. Diversifying your income means generating money from various sources, rather than depending on just one. This strategy is crucial for several reasons. Financial stability. Having multiple income streams reduces the risk of financial instability if one source of income is lost. For example, if you lose your primary job, having additional income from investments, rental properties, or a side business can help you stay afloat. Wealth accumulation. Multiple income streams can significantly boost your overall income, enabling you to save and invest more. This can accelerate your journey to financial independence and allow you to achieve your financial goals faster. Flexibility and freedom. Diversified income sources can provide greater flexibility and financial freedom. You might be able to pursue your passions, reduce your working hours, or even retire early if you have sufficient income from various sources. Active vs. Passive income. Understanding the difference between active and passive income is essential for building a diversified income portfolio. Both types of income have their advantages and can be leveraged to achieve financial success. Active income. Active income is money earned in exchange for performing a service or working a job. It requires your time and effort to generate income. Examples of active income include salaries and wages, money earned from a full-time or part-time job. Freelance work, income earned from providing services on a contract basis, such as writing, graphic design, or consulting. Side hustles, income from additional jobs or projects taken on outside of your primary employment. Pros. Typically provides a steady and reliable source of income. Allows you to leverage your skills and expertise to earn money. Cons. Requires ongoing time and effort. Limited by the number of hours you can work. Passive income. Passive income is money earned with minimal ongoing effort. Once the initial work is done, passive income streams can continue to generate money over time. Examples of passive income include investments, dividends from stocks, interest from bonds, or returns from mutual funds and ETFs. Rental income, money earned from leasing property to tenants. Royalties, income from intellectual property, such as books, music, or patents. Online businesses, earnings from e-commerce stores, affiliate marketing, or digital products. Pros. Can generate income without requiring active work. Scalable and can grow over time with the right investments and strategies. Cons. Often requires an initial investment of time or money. May involve some level of ongoing management and monitoring. Side hustles and part-time jobs. Side hustles and part-time jobs are excellent ways to create additional income streams. They can help you achieve financial goals more quickly and provide a safety net in case of job loss or other financial setbacks. Ideas for side hustles. Freelancing. Offer your skills on freelance platforms like Upwork, Fiverr, or Freelancer. Common freelance services include writing, graphic design, web development, and consulting. E-commerce. Start an online store on platforms like Etsy, eBay, or Shopify. Sell products you create, source, or curate. Gig economy jobs. Participate in the gig economy by driving for Uber or Lyft, delivering food with DoorDash or Postmates, or renting out a room on Airbnb. Tutoring. Offer tutoring services in subjects you excel in, either online or in person. Content creation. Create and monetize content on platforms like YouTube, Twitch, or through blogging and podcasting. Strategies for success. Leverage your skills. Focus on side hustles that utilize your existing skills and expertise. This can make it easier to start and increase your chances of success. Time management. Balance your side hustles with your primary job and personal life. Set specific hours for your side projects to avoid burnout. Invest in growth. Reinvest some of your earnings into growing your side hustle. This could mean improving your skills, marketing your services, or upgrading your equipment. Network. Connect with others in your industry to learn from their experiences, gain new opportunities, and expand your client base. Part-time jobs. If you prefer a more structured approach, consider taking on a part-time job. Part-time positions can provide a steady source of additional income with fewer responsibilities than a full-time job. Look for opportunities that align with your skills and interests, such as retail, hospitality, or administrative roles. Chapter 5. Investing Basics. Investing is a crucial component of building long-term wealth. By putting your money to work in various financial instruments, you can grow your wealth over time and achieve your financial goals. This chapter provides an introduction to investing, explains the relationship between risk and reward, and highlights the importance of building a diverse portfolio to mitigate risk. Introduction to investing. Investing involves allocating money to assets with the expectation of generating a return over time. Here, we'll explore the primary types of investments: stocks, bonds, mutual funds, and ETFs. Stocks. Stocks, also known as equities, represent ownership shares in a company. When you purchase a stock, you become a partial owner of that company and have a claim on its assets and earnings. Potential returns. Stocks have the potential for high returns through capital appreciation, increase in stock price, and dividends. Profit sharing. Risks. Stocks are subject to market volatility and can fluctuate in value based on company performance, economic conditions, and investor sentiment. Bonds. Bonds are debt securities issued by corporations, municipalities, or governments to raise capital. When you buy a bond, you are lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value at maturity. Potential returns. Bonds provide regular interest income and are generally considered less risky than stocks. Risks. Bond prices can fluctuate due to changes in interest rates, and there is a risk of default if the issuer cannot make interest payments or repay the principal. Mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. They are managed by professional fund managers who make investment decisions on behalf of the investors. Potential returns. Mutual funds offer diversification and professional management, which can lead to stable returns. Risks. The performance of mutual funds depends on the skills of the fund managers and market conditions. They also come with management fees that can impact returns. Exchange-traded funds, ETFs. ETFs are similar to mutual funds, but trade on stock exchanges like individual stocks. ETFs typically track an index such as the S&P 500, and offer a way to invest in a broad market segment. Potential returns: ETFs provide diversification, low expense ratios, and the flexibility to trade throughout the day. Risks: like mutual funds, ETF performance is tied to market conditions and the underlying assets they track. Risk and reward: understanding the relationship between risk and reward is essential for making informed investment decisions. All investments carry some level of risk, and the potential for higher returns usually comes with increased risk. Types of risk: market risk, the risk of investments losing value due to overall market declines. Credit risk, the risk that a bond issuer will default on interest payments or fail to repay the principal. Inflation risk, the risk that inflation will erode the purchasing power of investment returns. Interest rate risk, the risk that changes in interest rates will affect bond prices and yields. Liquidity risk, the risk that an investment cannot be easily sold or converted into cash without a significant loss in value. Balancing risk and reward. Investors must balance their desire for high returns with their tolerance for risk. This balance is influenced by factors such as investment goals, time horizon, and risk tolerance. Risk tolerance: your willingness and ability to endure fluctuations in the value of your investments. Time horizon: the length of time you plan to hold an investment before needing to access the funds. Longer time horizons typically allow for higher risk tolerance due to the ability to ride out market volatility. Building a diverse portfolio. Diversification is a risk management strategy that involves spreading investments across various asset classes, sectors, and geographies to reduce the impact of any single investment's poor performance on the overall portfolio. Importance of diversification. Mitigating risk: diversification reduces the risk of significant losses by ensuring that poor performance in one investment is offset by gains in others. Smoothing returns: a diversified portfolio tends to have more stable returns over time, as the performance of different assets can balance each other out. Access to opportunities: diversification provides exposure to a broader range of investment opportunities, increasing the potential for growth. Strategies for diversification. Asset allocation: allocate investments among different asset classes, such as stocks, bonds, real estate, and cash. The right mix depends on your risk tolerance, time horizon, and financial goals. Sector diversification: invest in various industries and sectors, such as technology, healthcare, finance, and consumer goods, to reduce the impact of sector-specific risks. Geographical diversification: invest in both domestic and international markets to mitigate the risk of economic downturns in a single region. Chapter 6: Real Estate Investment. Real estate investment is a time-honored method for building wealth and diversifying an investment portfolio. In this chapter, we will explore the basics of real estate investment, the different types of real estate investments available, and how to evaluate properties to assess their potential for generating returns. Real estate basics. Real estate is a tangible asset that can provide multiple streams of income, including rental income, appreciation, and tax benefits. Here are some reasons why real estate is a popular investment choice. Stable and tangible assets. Real estate is a physical, tangible asset that holds intrinsic value, unlike stocks or bonds, which can be volatile and subject to market fluctuations. Real estate generally provides a more stable investment, as property values tend to appreciate over time. Income generation. Real estate can generate consistent cash flow through rental income. Owning rental properties allows investors to earn passive income while potentially benefiting from property appreciation over the long term. Tax benefits. Investing in real estate offers various tax advantages. These include deductions for mortgage interest, property taxes, insurance, maintenance costs, and depreciation. These tax benefits can significantly enhance the overall return on investment. Hedge against inflation. Real estate is often considered a good hedge against inflation. As inflation rises, property values and rental incomes tend to increase as well, helping to preserve the purchasing power of your investment. Types of real estate investments. There are several types of real estate investments, each with its own characteristics, benefits, and risks. Understanding these options can help you make informed decisions about where to invest your money. Residential real estate. Residential real estate includes single-family homes, multifamily properties, condominiums, and townhouses. These properties are primarily used for living purposes and can be rented out to generate rental income. Pros: residential properties are often easier to finance, manage, and understand. They can provide steady rental income and potential appreciation. Cons: managing tenants and maintaining properties can be time-consuming and require ongoing effort. Rental income can fluctuate based on market conditions and tenant turnover. Commercial real estate. Commercial real estate includes office buildings, retail spaces, industrial properties, and warehouses. These properties are used for business purposes and typically involve longer lease terms compared to residential properties. Pros: commercial properties can offer higher rental yields, longer lease terms, and professional tenants. They may also provide opportunities for significant appreciation. Cons: commercial properties often require larger initial investments, more complex management, and can be affected by economic cycles and business trends. Real estate investment trusts, REITs. REITs are companies that own, operate, or finance income-generating real estate across various sectors. Investors can buy shares of REITs, providing a way to invest in real estate without directly owning properties. Pros: REITs offer liquidity, diversification, and professional management. They provide an easy way to invest in real estate with a lower initial investment. Cons: REITs are subject to stock market volatility and may not provide the same level of control and tax benefits as direct property ownership. Other types of real estate investments. Vacation rentals. Short-term rental properties in desirable vacation destinations can generate higher rental income but may require more active management. Real estate crowdfunding. Platforms that allow investors to pool money to invest in real estate projects, providing access to larger deals with lower individual investments. Land investments, investing in undeveloped land for future development or appreciation. This can be a speculative investment with potential for high returns, but also higher risk. Evaluating properties. Assessing the potential of a real estate investment involves careful analysis of various factors. Here are key steps to evaluate properties effectively. Location. The location of a property is one of the most critical factors in real estate investment. Consider the following. Neighborhood quality. Look for properties in desirable neighborhoods with good schools, low crime rates, and proximity to amenities such as shopping, parks, and public transportation. Market trends. Research local real estate market trends, including property values, rental rates, and vacancy rate. Areas with strong growth potential and demand for housing are ideal for investment. Future development. Consider the impact of planned infrastructure projects, commercial developments, or zoning changes that could affect property values and desirability. Property condition. Assess the physical condition of the property to determine necessary repairs or renovations. Inspection. Hire a professional inspector to identify any structural issues, plumbing or electrical problems, and potential maintenance concerns. Renovation costs. Estimate the cost of any needed repairs or upgrades. Factor these costs into your investment analysis to determine the property's overall profitability. Financial analysis. Perform a thorough financial analysis to evaluate the potential return on investment. Purchase price. Ensure the purchase price aligns with comparable properties in the area and provides room for appreciation. Rental income. Estimate the potential rental income based on comparable properties and current market rates. Consider factors such as occupancy rates and seasonal variations. Expenses. Account for all operating expenses, including property taxes, insurance, maintenance, property management fees, and utilities. Cash flow. Calculate the property's net cash flow by subtracting expenses from rental income. Positive cash flow indicates a profitable investment. Cap rate. The capitalization rate, cap rate, is a measure of the property's potential return, calculated by dividing the net operating income by the property's purchase price. A higher cap rate indicates a better return on investment. Risk assessment. Identify potential risks associated with the investment and develop strategies to mitigate them. Market risk. Monitor local and broader economic trends that could impact property values and rental demand. Tenant risk. Implement thorough tenant screening processes to reduce the risk of non-payment or property damage. Management risk. Consider hiring a professional property management company to handle tenant relations, maintenance, and day-to-day operations. Chapter 7. Entrepreneurship. Entrepreneurship is a powerful path to wealth creation and financial independence. Starting and growing your own business allows you to leverage your skills, passion, and creativity to generate income and build long-term wealth. In this chapter, we will explore the steps to launch your own business, strategies for scaling and expanding, and the importance of building a strong brand through effective branding and marketing. Starting a business. Launching a business requires careful planning and execution. Here are the essential steps to get started. 1. Identify your business idea. Start by identifying a business idea that aligns with your skills, interests, and market demand. Consider the following: passion and expertise. Choose a business idea that you are passionate about and have expertise in. This will keep you motivated and increase your chances of success. Market research. Conduct market research to understand the demand for your product or service. Identify your target audience and analyze the competition. Unique value proposition. Define what sets your business apart from competitors and how it adds value to customers. This unique value proposition will be a cornerstone of your business strategy. 2. Create a business plan. A well-structured business plan outlines your business goals, strategies, and financial projections. It serves as a roadmap for your business and can help secure funding from investors or lenders. Key components of a business plan include executive summary, an overview of your business, including the mission statement, products or services, and key objectives. Market analysis, insights into the industry, target market, and competitive landscape. Marketing and sales strategy, plans for promoting your business, attracting customers, and driving sales. Operations plan, details on how your business will operate, including location, technology, and staffing. Financial projections, revenue forecasts, expense estimates, and profitability projections. 3. Secure funding. Determine the amount of capital needed to start and run your business. Explore various funding options, such as self-funding using personal savings or assets to finance your business. Loans, obtaining a business loan from a bank or financial institution. Investors, attracting angel investors or venture capitalists who are willing to invest in exchange for equity in your business. Crowdfunding, raising funds from a large number of people through platforms like Kickstarter or Indiegogo. 4. Register your business. Choose a business name and register it with the appropriate government authorities. Decide on the legal structure of your business, such as a sole proprietorship, partnership, limited liability company, LLC, or corporation. Each structure has its own legal and tax implications. 5. Set up your operations. Establish the operational aspects of your business, including Location, choose a physical location or set up an online presence. Licenses and permits, obtain any necessary licenses and permits required for your industry. Technology and equipment, acquire the technology, tools, and equipment needed to run your business efficiently. Hiring, recruit, and hire employees or contractors to support your business operations. 6. Launch your business. With all the groundwork in place, it's time to launch your business. Announce your launch through marketing campaigns, social media, and public relations efforts. Offer promotions or special deals to attract your first customers and generate buzz around your brand. Scaling your business. Once your business is up and running, focus on strategies for growth and expansion. Scaling your business involves increasing your capacity to serve more customers and generate higher revenue. 1. Optimize operations. Streamline your operations to improve efficiency and reduce costs. Consider the following: automation, implement technology and automation tools to streamline repetitive tasks and improve productivity. Outsourcing, outsource non-core functions, such as accounting, marketing, or customer service to specialized providers. Process improvement, continuously analyze and improve your business processes to enhance quality and efficiency. 2. Expand your product or service offerings. Diversify your revenue streams by expanding your product or service offerings. Consider the following strategies. New products or services. Introduce new products or services that complement your existing offerings and meet customer needs. Market expansion. Enter new markets or geographic regions to reach a broader audience. Partnerships. Form strategic partnerships or alliances with other businesses to offer bundled products or services. 3. Increase sales and marketing efforts. Invest in sales and marketing to attract new customers and retain existing ones. Effective strategies include digital marketing, NCO. Customer relationship management, CRM. Implement a CRM system to manage customer interactions, track sales, and improve customer service. Sales team. Expand your sales team to reach more customers and close more deals. 4. Secure additional funding. To support your growth initiatives, you may need additional capital. Explore funding options such as business loans. Apply for business expansion loans or lines of credit. Equity financing. Raise capital by offering equity to investors or venture capitalists. Revenue-based financing. Obtain funding based on your business's revenue performance. Building a brand. A strong brand is essential for attracting customers, building loyalty, and differentiating your business from competitors. Branding and marketing play a critical role in establishing and growing your brand. 1. Define your brand identity. Your brand identity encompasses your business's values, mission, vision, and personality. Key elements include brand name. Choose a memorable and meaningful name that reflects your business. Logo and visuals. Create a visually appealing logo and design elements that represent your brand. Brand voice. Develop a consistent tone and style for your brand's communication. 2. Develop a brand strategy. A brand strategy outlines how you will build and promote your brand. Consider the following components. Target audience. Clearly define your target audience and understand their needs, preferences, and behaviors. Unique selling proposition, USP. Highlight what makes your brand unique and why customers should choose you over competitors. Brand messaging. Craft compelling messages that resonate with your audience and communicate your brand's value. 3. Implement marketing campaigns. Execute marketing campaigns to raise brand awareness, attract customers, and drive sales. Effective marketing channels include content marketing. Create valuable and engaging content, such as blog posts, videos, and infographics, to educate and entertain your audience. Social media. Utilize social media platforms to connect with your audience, share updates, and build a community around your brand. Email marketing. Build an email list and send targeted campaigns to nurture leads and retain customers. Advertising. Invest in online and offline advertising to reach a broader audience and increase brand visibility. 4. Build customer relationships. Strong customer relationships are the foundation of a successful brand. Focus on providing exceptional customer service and creating memorable experiences. Strategies include personalization, personalized interactions, and offers based on customer preferences and behaviors. Feedback. Actively seek and respond to customer feedback to improve your products, services, and customer experience. Loyalty programs. Implement loyalty programs to reward repeat customers and encourage referrals. Chapter 8. Retirement planning. Retirement planning is a critical aspect of achieving long-term financial security and independence. By starting early, understanding the various retirement accounts available, and accurately calculating your retirement needs, you can ensure a comfortable and worry-free retirement. This chapter explores the importance of early planning, provides an overview of different retirement accounts, and offers guidance on determining how much you need to retire comfortably. Importance of early planning. Starting your retirement planning early offers several significant advantages that can positively impact your financial future. Benefits of early planning. Compound interest. The earlier you start saving for retirement, the more time your money has to grow through compound interest. Even small contributions can grow significantly over time due to the compounding effect. Financial security. Early planning allows you to build a substantial retirement fund, reducing financial stress and ensuring a secure future. Flexibility. With a solid retirement plan in place, you have more flexibility to adjust your savings rate, investment strategies, and retirement goals as needed. Inflation protection. Starting early helps you stay ahead of inflation, ensuring that your retirement savings maintain their purchasing power over time. Peace of mind. Knowing that you have a well-thought-out retirement plan provides peace of mind and allows you to focus on other financial goals and life priorities. Retirement accounts. Understanding the various retirement accounts available is essential for making informed decisions about where to invest your retirement savings. Here, we will explore the most common retirement accounts: 401(k), S, IRAs, and other options. 401(k) plans. A 401(k) plan is an employer-sponsored retirement account that allows employees to contribute a portion of their salary on a pre-tax basis. Key features of 401(k) plans include employer contributions. Many employers offer matching contributions, which can significantly boost your retirement savings. For example, if your employer matches 50% of your contributions up to 6% of your salary, you receive an additional 3% of your salary in matching funds. Tax benefits. Contributions to a traditional 401(k) are made with pre-tax dollars, reducing your taxable income. Taxes are deferred until you withdraw the money in retirement. Contribution limits. For 2023, the maximum contribution limit for a 401(k) is $22,500 for individuals under $50,000 and $30,000 for those 50 and older, including catch-up contributions. Investment options. 401(k) plans typically offer a range of investment options, including mutual funds, index funds, and target date funds. Individual retirement accounts, IRAs. An individual retirement account, IRA, is a personal retirement savings account that offers tax advantages. There are two main types of IRAs: traditional IRAs and Roth IRAs. Traditional IRA. Tax benefits. Contributions to a traditional IRA may be tax deductible, and the account grows tax-deferred until withdrawals are made in retirement. Contribution limits. For 2023, The maximum contribution limit for IRAs is $6,500 for individuals under 50 and $7,500 for those 50 and older, including catch-up contributions. Required minimum distributions, RMDs. Traditional IRAs require you to start taking RMDs at age 72. Roth IRA. Tax benefits. Contributions to a Roth IRA are made with after-tax dollars, but qualified withdrawals in retirement are tax-free. Contribution limits. The same contribution limits apply to Roth IRAs as to traditional IRAs. No RMDs. Roth IRAs do not require RMDs, allowing your savings to grow tax-free for as long as you choose. Other retirement accounts. SEP IRA, a simplified employee pension. SEP IRA is designed for self-employed individuals and small business owners. It allows for higher contribution limits than traditional IRAs, making it an attractive option for business owners. SIMPLE IRA, a savings incentive match plan for employees. SIMPLE IRA is another retirement plan option for small businesses. It is easier to set up and manage than a 401(k) plan, with lower contribution limits but similar tax benefits. HSA, a health savings account. HSA can also serve as a retirement savings vehicle. Contributions are tax-deductible, and withdrawals for qualified medical expenses are tax-free. After age 65, non-medical withdrawals are subject to regular income tax, similar to a traditional IRA. Calculating your retirement needs. Determining how much you need to retire comfortably involves careful analysis of your expected expenses, lifestyle, and income sources in retirement. Here are the key steps to calculate your retirement needs. 1. Estimate your retirement expenses. Start by estimating your annual expenses in retirement. Consider the following categories: housing, mortgage or rent, property taxes, insurance, maintenance, and utilities. Healthcare, insurance premiums, out-of-pocket medical expenses, and long-term care. Living expenses, groceries, transportation, clothing, and personal care. Lifestyle, travel, hobbies, entertainment, and dining out. Inflation. Account for inflation by projecting an annual increase in expenses, typically around 2–3%. 2. Determine your retirement income. Identify the sources of income you will have in retirement, such as Social Security. Estimate your Social Security benefits based on your earnings history and planned retirement age. Pension. If you have a pension plan, include the expected monthly payments. Retirement accounts. Calculate the expected withdrawals from your 401(k), IRAs, and other retirement accounts. Investment income. Include income from taxable investment accounts, rental properties, and other income-generating assets. 3. Calculate the savings needed. Subtract your estimated annual retirement income from your estimated annual retirement expenses to determine the annual shortfall. Multiply this shortfall by the number of years you expect to be in retirement to calculate the total savings needed. Consider the following factors. Life expectancy. Estimate your life expectancy based on your health, family history, and lifestyle. Planning for a longer retirement period provides a buffer for unexpected longevity. Withdrawal rate. Use a safe withdrawal rate, such as the 4% rule, to determine how much you can withdraw annually from your retirement savings without depleting your funds too quickly. 4. Adjust for additional factors. Emergency fund. Maintain an emergency fund to cover unexpected expenses and reduce the need to withdraw from retirement accounts prematurely. Debt. Pay off high-interest debt before retirement to minimize financial stress and reduce your overall expenses. Retirement age. Consider the impact of retiring earlier or later on your savings and income. Delaying retirement can increase your savings and Social Security benefits. Chapter 9. Managing debt. Debt management is a crucial aspect of achieving financial stability and building wealth. Understanding different types of debt, implementing effective debt reduction strategies, and knowing when to use debt management services can help you take control of your financial situation. In this chapter, we will explore the implications of various types of debt, provide methods for paying off debt, and discuss when and how to use debt management plans. Understanding debt. Debt comes in various forms, each with its own implications for your financial health. Understanding the types of debt you have can help you develop a plan to manage and eliminate it. Types of debt. Secured debt. This type of debt is backed by collateral, such as a house or car. Examples include mortgages and auto loans. If you default on a secured debt, the lender can repossess the collateral. Implications: lower interest rates compared to unsecured debt. Risk of losing the collateral if you default. Unsecured debt. This debt is not backed by collateral and includes credit card debt, personal loans, and medical bills. Because there is no collateral, lenders typically charge higher interest rates. Implications: higher interest rates affects credit score more significantly if not managed properly. Revolving debt. This type of debt allows you to borrow up to a certain limit and pay it off over time, such as with credit cards and lines of credit. The balance and minimum payment can vary each month. Implications: flexible borrowing options can lead to high interest charges if not paid off quickly. Installment debt. This debt involves borrowing a fixed amount and repaying it in equal monthly installments over a set period, such as student loans and personal loans. Implications: predictable payments. Interest rates can vary, depending on the loan type and borrower's creditworthiness. Good debt vs. bad debt. Good debt is typically associated with investments that generate long-term value, such as student loans, education, and mortgages. Real estate. Bad debt, on the other hand, is often associated with high interest rates and depreciating assets, such as credit card debt for consumer purchases. Implications: good debt can help build wealth. Bad debt can hinder financial progress and should be managed carefully. Debt reduction strategies. Reducing and eliminating debt is essential for achieving financial freedom. Here are some effective strategies for paying off debt. 1. The debt snowball method. The debt snowball method involves paying off your smallest debts first while making minimum payments on larger debts. Once a small debt is paid off, you roll its payment into the next smallest debt, creating a snowball effect. Advantages: provides quick wins and motivation by eliminating smaller debts first. Steps: list your debts from smallest to largest balance. Make minimum payments on all debts except the smallest. Allocate extra funds to pay off the smallest debt. Repeat the process, moving to the next smallest debt. 2. The debt avalanche method. The debt avalanche method focuses on paying off debts with the highest interest rates first, while making minimum payments on other debts. This method minimizes the total interest paid over time. Advantages: saves money on interest payments in the long run. Steps: list your debts from highest to lowest interest rate. Make minimum payments on all debts except the one with the highest interest rate. Allocate extra funds to pay off the debt with the highest interest rate. Repeat the process, moving to the next highest interest rate debt. 3. Balance transfer. A balance transfer involves moving high-interest credit card debt to a card with a lower interest rate, often with an introductory 0% APR period. This can help you pay off the principal faster without accruing additional interest. Advantages: reduces interest payments, can accelerate debt payoff. Considerations: be aware of balance transfer fees and the duration of the introductory period. 4. Debt consolidation. Debt consolidation involves combining multiple debts into a single loan with a lower interest rate. This can simplify your payments and potentially reduce your interest costs. Advantages: simplifies debt management, may lower interest rates. Considerations: ensure the consolidation loan has a lower interest rate than your existing debts, and avoid accumulating new debt. 5. Increasing income. Increasing your income through side hustles, part-time jobs, or salary negotiations can provide extra funds to pay off debt faster. Advantages: accelerates debt payoff, improves overall financial situation. Considerations: balance additional work with personal time and avoid burnout. Debt management plans. In some cases, managing debt on your own may be challenging. Debt management plans, DEMPs, can provide structured assistance to help you get back on track. When to consider a debt management plan. High debt levels. If you have significant debt that you cannot manage on your own. Struggling with payments. If you are consistently missing payments, or only making minimum payments. High interest rates. If high interest rates are preventing you from making progress on your debt. How debt management plans work. A DMP is typically offered by credit counseling agencies. Here's how it works. Assessment. A credit counselor assesses your financial situation, including your income, expenses, and debts. Negotiation. The counselor negotiates with your creditors to reduce interest rates, waive fees, and establish a manageable repayment plan. Single payment. You make a single monthly payment to the credit counseling agency, which then distributes the funds to your creditors. Debt repayment. You follow the repayment plan until your debts are paid off, typically within 3-5 years. Finding a reputable credit counseling agency. Accreditation. Look for agencies accredited by organizations such as the National Foundation for Credit Counseling, NFCC, or the Financial Counseling Association of America, FCAA. Transparency. Ensure the agency is transparent about fees, services, and the DMP process. Reviews and referrals. Check reviews and ask for referrals from trusted sources to find a reputable agency. Chapter 10. Protecting your wealth. Accumulating wealth is only part of the journey to financial success. Protecting your wealth is equally important to ensure your financial security and legacy. This chapter covers the basics of insurance, various types of insurance necessary to protect your assets, and the essentials of estate planning to safeguard your wealth for future generations. Insurance basics. Insurance is a critical tool for protecting your assets and providing financial security. It acts as a safety net, helping you manage risks and unexpected events that could otherwise deplete your wealth. The importance of insurance. Risk management. Insurance helps manage financial risks by transferring the burden of potential loss to an insurance company. This allows you to recover more easily from unexpected events. Financial security. Insurance provides a financial cushion, ensuring that you and your family are protected from significant financial hardships. Peace of mind. Knowing that you have coverage for potential risks offers peace of mind, allowing you to focus on wealth building without constant worry about unexpected financial setbacks. Legal and regulatory requirements. Some types of insurance, such as auto and health insurance, are legally required. Others, like workers' compensation, may be necessary for business owners to comply with regulations. Types of insurance. To protect your wealth effectively, you need to understand and invest in various types of insurance. Here, we explore the most essential insurance types: health, life, property, and liability insurance. Health insurance. Health insurance covers medical expenses incurred due to illness or injury. It is vital for protecting your financial health, as medical bills can be a significant burden. Coverage. Health insurance typically covers hospital stays, surgeries, doctor visits, prescription medications, and preventive care. Types. Common types include employer-sponsored plans, individual plans, and government programs like Medicare and Medicaid. Benefits. Reduces out-of-pocket medical expenses, provides access to necessary healthcare services, and promotes preventive care. Life insurance. Life insurance provides financial protection for your loved ones in the event of your death. It ensures that they are financially secure and can cover expenses such as funeral costs, debts, and living expenses. Types. Term life insurance provides coverage for a specific period, e.g. 10, 20, or 30 years. It is generally more affordable, but does not build cash value. Whole life insurance offers lifetime coverage with a cash value component that grows over time. It is more expensive but provides additional benefits. Universal life insurance combines term and whole life insurance features, offering flexible premiums and death benefits. Benefits provides financial security for dependents, covers debts and final expenses, and can be used as a wealth transfer tool. Property insurance. Property insurance protects your physical assets, such as your home, car, and personal belongings, from damage or loss due to events like fire, theft, or natural disasters. Homeowners insurance covers your home and personal property, as well as liability for accidents that occur on your property. Renters insurance protects your personal belongings if you rent a home or apartment and provides liability coverage. Auto insurance covers damages to your vehicle and liability for accidents involving your car. It typically includes collision, comprehensive, and liability coverage. Benefits provides financial protection against property loss or damage, covers repair or replacement costs, and reduces out-of-pocket expenses. Liability insurance. Liability insurance protects you from financial loss if you are found legally responsible for causing injury or damage to others. It covers legal fees, medical expenses, and damages. Types. Personal liability insurance, included in homeowners or renters insurance, covering accidents that occur on your property. Umbrella insurance provides additional liability coverage beyond the limits of your primary policies, such as home or auto insurance. Professional liability insurance covers professionals, such as doctors and lawyers, against claims of negligence or malpractice. Benefits protects your assets from legal claims, covers legal and medical expenses, and provides peace of mind. Estate planning. Estate planning involves preparing for the management and distribution of your assets after your death. It ensures that your wealth is preserved and passed on according to your wishes. Creating a will. A will is a legal document that outlines how your assets should be distributed upon your death. It also allows you to name an executor to manage your estate and guardians for minor children. Benefits ensures your assets are distributed according to your wishes, minimizes disputes among heirs, and provides for the care of minor children. Key elements include details about asset distribution, appointment of an executor, designation of guardians, and instructions for debt payment and funeral arrangements. Trusts. A trust is a legal arrangement in which a trustee holds and manages assets on behalf of beneficiaries. Trusts can provide more control over asset distribution and offer tax benefits. Types. Revocable living trust allows you to retain control of your assets during your lifetime and provides for asset management if you become incapacitated. Irrevocable trust transfers assets out of your estate, potentially reducing estate taxes and providing creditor protection. Special needs trust provides for a disabled beneficiary without affecting their eligibility for government benefits. Benefits offers greater control over asset distribution, reduces estate taxes, and provides privacy and protection for beneficiaries. Power of attorney. A power of attorney is a legal document that grants someone the authority to act on your behalf if you become incapacitated. This can include managing financial affairs, making medical decisions, and handling legal matters. Types. Durable power of attorney remains in effect if you become incapacitated and covers financial and legal matters. Healthcare power of attorney grants someone the authority to make medical decisions on your behalf. Benefits ensures your affairs are managed according to your wishes, provides continuity in decision-making, and avoids the need for court-appointed guardianship. Beneficiary designations. Review and update beneficiary designations on accounts such as life insurance, retirement plans, and bank accounts. These designations determine who will receive the assets upon your death and override instructions in your will. Benefits simplifies the transfer of assets, ensures assets go to the intended beneficiaries, and can avoid probate for those assets. Estate taxes. Understanding and planning for estate taxes can help preserve your wealth for your heirs. Strategies such as gifting, trusts, and charitable donations can reduce the tax burden on your estate. Federal estate tax applies to estates exceeding a certain value, with an exclusion amount that changes annually. State estate taxes. Some states impose their own estate or inheritance taxes with different thresholds and rates. Benefits. Reduces the tax burden on your estate, maximizes the amount passed to heirs, and supports charitable causes. Chapter 11. Advanced Investing Strategies. As you become more experienced in building and protecting your wealth, exploring advanced investing strategies can offer new opportunities for significant financial growth. In this chapter, we will delve into 3 advanced investment options: real estate syndications, angel investing, and cryptocurrency, and digital assets. Each of these strategies comes with its own set of opportunities and risks, requiring careful consideration and due diligence. Real estate syndications. Real estate syndication is a method of pooling resources from multiple investors to purchase larger real estate properties that would be difficult to acquire individually. This strategy can provide access to high-quality investment opportunities and diversify your real estate portfolio. What is real estate syndication? Real estate syndication involves a partnership between a syndicator, also known as the sponsor, and a group of investors. The syndicator identifies, acquires, and manages the property, while the investors provide the necessary capital. Syndicator's role. The syndicator is responsible for sourcing deals, conducting due diligence, arranging financing, managing the property, and eventually selling it for a profit. In return, the syndicator receives a fee and a share of the profits. Investor's role. Investors contribute capital and receive ownership shares in the property. They benefit from passive income through rental returns and potential appreciation upon the sale of the property. Benefits of real estate syndications. Access to larger deals. Syndication allows individual investors to participate in larger, potentially more profitable real estate deals that they might not afford on their own. Diversification. Investing in syndications enables diversification across different property types and geographical locations. Professional management. The syndicator's expertise in property management and operations can lead to better investment outcomes. Passive income. Investors receive regular income distributions without the responsibilities of day-to-day property management. Risks and considerations. Lack of control. Investors have limited control over the property's management and decisions. Illiquidity. Real estate syndications are typically long-term investments, and it may be difficult to sell your ownership interest before the property is sold. Market risk. Real estate market fluctuations can impact property values and rental income. Sponsor risk. The success of the investment heavily depends on the syndicator's expertise and management. Angel investing. Angel investing involves providing capital to startups and early-stage businesses in exchange for equity ownership. This high-risk, high-reward strategy can lead to substantial returns if the business succeeds. What is angel investing? Angel investors are typically high-net-worth individuals who invest their own funds in early-stage companies. In addition to capital, they may also provide mentorship, industry connections, and strategic guidance to the startups they support. Seed funding. Angel investors often provide seed funding. the initial capital that helps startups develop their product or service, build a team, and achieve early milestones. Equity ownership. In return for their investment, angels receive equity ownership, which can appreciate significantly if the startup grows and succeeds. Benefits of angel investing. Potential for high returns. Successful startups can provide substantial returns on investment, especially if they achieve significant growth or are acquired. Diversification. Angel investing allows for diversification into high-growth sectors and innovative business models. Personal fulfillment. Supporting entrepreneurial ventures can be personally rewarding, as it contributes to innovation and job creation. Networking opportunities. Angel investors often join angel groups or networks, providing access to a community of like-minded investors and industry professionals. Risks and considerations. High risk. Startups have a high failure rate, and there is a significant risk of losing the entire investment. Illiquidity. Angel investments are typically illiquid, with no immediate exit opportunities. Returns may take years to materialize. Valuation challenges. Assessing the value and potential of early-stage companies can be challenging and requires careful due diligence. Active involvement. While some angels prefer a hands-off approach, others may need to be actively involved in mentoring and supporting the startup. Cryptocurrency and digital assets. Cryptocurrency and digital assets have emerged as a new and exciting asset class, offering significant opportunities and risks. Understanding these digital investments is crucial for making informed decisions. What are cryptocurrencies? Cryptocurrencies are digital or virtual currencies that use cryptography for security. The most well-known cryptocurrency is Bitcoin, but there are thousands of others, including Ethereum, Ripple, and Litecoin. These digital assets operate on decentralized networks using blockchain technology. Blockchain technology. A blockchain is a distributed ledger that records all transactions across a network of computers. It ensures transparency, security, and immutability of the transaction data. Decentralization. Cryptocurrencies are not controlled by any central authority, such as a government or financial institution, making them resistant to censorship and manipulation. Benefits of cryptocurrency investing. High potential returns. Cryptocurrencies have experienced significant price appreciation, offering the potential for substantial returns. Diversification. Digital assets provide diversification opportunities beyond traditional asset classes like stocks and bonds. Innovation and technology. Investing in cryptocurrencies supports the development of blockchain technology and its applications. Global accessibility. Cryptocurrencies can be accessed and traded globally, providing investment opportunities regardless of geographical location. Risks and considerations. Volatility. Cryptocurrency prices are highly volatile, leading to significant price swings and potential losses. Regulatory risk. The regulatory environment for cryptocurrencies is evolving, and changes in regulations can impact their value and legality. Security concerns. Digital assets are susceptible to hacking, fraud, and loss due to inadequate security measures. Lack of fundamental valuation. Unlike traditional assets, cryptocurrencies do not have intrinsic value based on cash flows or earnings, making valuation challenging. Chapter 12. Philanthropy and Giving Back. Accumulating wealth brings with it a sense of responsibility and the opportunity to make a positive impact on the world. Philanthropy and giving back are integral components of a holistic approach to wealth. This chapter explores the role of philanthropy in personal fulfillment and community betterment, strategies for effective charitable giving, and how to build a lasting legacy that ensures your wealth has a positive and enduring impact. The role of philanthropy. Philanthropy goes beyond mere financial donations. It involves a commitment to improving the lives of others and addressing social, cultural, or environmental issues. Engaging in philanthropy can bring numerous benefits, both to the giver and the recipients. Personal fulfillment. Sense of purpose. Giving back can provide a deeper sense of purpose and meaning in life, aligning your wealth with your values and passions. Happiness and well-being. Studies have shown that acts of generosity and helping others can enhance personal happiness and well-being. Personal growth. Philanthropy can foster personal growth by broadening your perspective, increasing empathy, and enhancing your understanding of global issues. Community impact. Addressing needs. Philanthropic efforts can address critical needs in your community, such as education, healthcare, poverty alleviation, and environmental conservation. Fostering social change by supporting initiatives that promote social justice and equality. Philanthropy can contribute to systemic changes and long-term improvements. Strengthening community bonds. Philanthropy can strengthen community bonds and encourage a culture of giving and collaboration. Creating a charitable giving plan. A well-thought-out charitable giving plan ensures that your contributions are effective, impactful, and aligned with your values. Here are strategies to create a robust giving plan. Identifying your values and causes. Reflect on your values. Identify the values and principles that are most important to you. Consider how these values can guide your philanthropic efforts. Research causes. Research various causes and organizations to determine which align best with your values and have a meaningful impact. Prioritize the causes that resonate most deeply with you and where you believe your contributions can make the most significant difference. Setting goals and budget. Define your goals. Set clear, specific goals for your philanthropic efforts. Consider what you hope to achieve and how you will measure success. Determine your budget. Decide how much of your wealth you are willing to allocate to charitable giving. This can be a fixed percentage of your income or a specific amount each year. Consider tax implications. Understand the tax benefits of charitable giving, such as deductions for donations, and incorporate these into your financial planning. Choosing the right giving methods. Direct donations. Making direct donations to nonprofits and charitable organizations is the most straightforward method of giving. Donor-advised funds. DAFs allow you to make a charitable contribution, receive an immediate tax deduction, and recommend grants from the fund over time. Charitable trusts. Establishing a charitable trust, such as a charitable remainder trust or charitable-led trust, can provide tax benefits and a structured way to give. Volunteering. Donating your time and expertise can be just as valuable as financial contributions, providing hands-on support to causes you care about. Legacy building. Building a legacy through philanthropy ensures that your wealth continues to have a positive impact long after you are gone. Legacy building involves thoughtful planning and a commitment to long-term change, creating a lasting impact. Endowments. Establishing an endowment fund provides a permanent source of funding for a cause or organization, generating ongoing income from invested principal. Foundation. Creating a private foundation allows you to direct substantial resources to specific causes and provides a structured framework for ongoing philanthropic efforts. Scholarships. Setting up scholarships can support education and personal development, leaving a lasting impact on individuals and communities. Involving your family. Educate and engage. Educate your family about the importance of philanthropy and involve them in your giving plans. This can foster a shared commitment to giving back. Create a family giving tradition. Establish family traditions around charitable giving, such as annual donations or volunteer activities, to instill philanthropic values in future generations. Succession planning. Plan for the succession of your philanthropic efforts by designating family members or trusted advisors to continue your legacy. Communicating your legacy. Document your wishes. Clearly document your philanthropic wishes and intentions in your estate plan, ensuring that your legacy is honored and continued. Share your story, share your philanthropic journey and the reasons behind your giving with family, friends, and the organizations you support. This can inspire others and provide guidance for future generations. Celebrate milestones and successes in your philanthropic efforts, recognizing the impact of your contributions and encouraging continued commitment. Conclusion: building wealth is a journey that requires knowledge, discipline, and a proactive approach. Throughout this book, we've explored the essential elements of wealth creation and preservation, from developing a wealth mindset to advanced investing strategies and the importance of philanthropy. By following the principles and strategies outlined in these chapters, you can take control of your financial future and achieve the wealth and success you desire. The journey to wealth. Wealth is not merely about accumulating money. It's about creating a secure and fulfilling life for yourself and your loved ones. This journey begins with the right mindset and attitude, recognizing that your beliefs and attitudes towards money profoundly influence your financial success. Overcoming limiting beliefs and setting clear financial goals provide the foundation for your wealth-building journey. Financial education and planning. Understanding personal finance is crucial. Budgeting, saving, and investing form the core of financial management. Learning about the power of compound interest and seeking financial literacy resources can enhance your knowledge and confidence in managing your finances. Creating a budget, adhering to the 50/30/20 rule, and implementing effective saving strategies are practical steps that pave the way for financial stability. Income and investments. Diversifying your income streams through active and passive means, exploring side hustles, and understanding basic and advanced investing strategies are critical to growing your wealth. Investing in stocks, bonds, real estate, and digital assets requires an understanding of risk and reward, as well as the importance of building a diverse portfolio. Protecting and planning. Managing debt effectively, protecting your wealth through insurance, and planning for retirement and your estate ensure that your financial achievements are safeguarded. Creating a retirement plan, understanding various retirement accounts, and calculating your retirement needs help secure your financial future. Similarly, estate planning and insurance protect your assets and provide peace of mind. Giving back and leaving a legacy. Philanthropy and giving back play a vital role in creating a lasting impact. Developing a charitable giving plan, understanding the importance of legacy building, and involving your family in philanthropic efforts ensure that your wealth benefits others and continues to make a positive difference. Taking control of your financial future. By embracing the knowledge and strategies presented in this book, you are equipped to take proactive steps toward building and maintaining wealth. Remember, wealth building is a continuous process that requires dedication, adaptability, and ongoing learning. Stay informed, remain disciplined, and be proactive in your financial decisions. Your journey to wealth is unique, and with the right mindset and tools, you can achieve financial independence and the success you desire. Whether you're just starting out or looking to enhance your existing financial strategies, the principles in this book provide a comprehensive guide to navigating the complexities of wealth creation and management. Embrace this journey with confidence and take control of your financial future. The wealth and success you desire are within your reach.